financial planner, a competent advisor that will sit with you and work through some of the areas of concern for you. So we want to avail ourselves for that. And I guess the process we're going to be following today is much like we've started off here already. We're going to facilitate a bit of a conversation. Harpia's got a slide deck that him and Tango are going to speak through. But for the most part, we want to ask you to engage with us in that chat window. If you've got any questions pertaining to your business, any questions pertaining to your lifestyle and your financial plan, we want you to feel free to go to that chat window and just please send us those questions. Finally, I want to direct you to an email address that I'm going to pop in the chat in a moment. It is lifeplan@pps.co.za. That's the email address where you can engage with us, where you can connect with us. And please, we welcome you reaching out to us. If there's a need that you see that has not been answered and not been addressed in your life and in your business, we want you to know that PPS is here for you to come to and where you can get some peace of mind. That's the biggest payoff from this session. Peace of mind. When you engage with one of our competent, trustworthy planners, you will leave that engagement knowing that your business, its employees, the shareholders of that business, the families associated to that business can all have peace of mind knowing that you have had the smarts, the foresight to take a look at your financial plan, look at the risks that are involved, and those are covered. At this point in time, I would love to start a poll. Let us see, just go to the poll. I'm launching the poll right now. We've got 3 questions. I'd love for you to answer there. The first question is, are you a business owner? We want to know if you're a business owner, let us know. You either answer yes or no. Go to your poll. It should have popped up on your screen. That's question number 1. Are you a business owner? Question number 2 is, have you identified the key individual or key individuals in your business? Have you done that? Have you identified who are the key individuals in your business? And then finally, question number 3, do you have a buy and sell plan in place? And what we are hoping there is that none of you are saying, what on earth is a buy and sell plan? And if that is the question you've got, Harpia and Tango are definitely going to answer that throughout the course of today's presentation. So far, I mean, not everybody has answered, but 67% of the people on this call are business owners, Tango and Harpia. 67% of people have also identified the key owners. I'm wondering if those are the same people. And 67% of people do have a buy and sell plan in place. So guys, continue to answer the poll. It will continue running. It's up there for your engagement. Please do engage with us. Tell us where you stand concerning these 3 things. Are you a business owner? Have you identified the key individuals in your business? And do you have a buy and sell in place? And I guess that's the note for me to kind of do a rugby pass over. And I'm passing it over to Tango. Tango, there's a nice rugby pass to you. To introduce you to everybody, guys, this is Tango Gatia. He's one of the regional general managers here at PPS. He's got 10 years worth of experience. That's what we're going to be hearing from Tango today, a wealth of knowledge and wisdom that he's going to share with us today. Tango, as you may have guessed, is a rugby and a fitness fan, but he also loves observing the markets, both financial and political landscapes. Tango is most passionate about connecting competent and trusted advisors to clients and members who need service. Tango, welcome. Looking forward to hearing what you will be sharing with us today. Some opening remarks from you, Tango, before I introduce Harpia.
Great. Thank you for the warm welcome, and welcome to all the participants. Looking forward to engaging with all of you and really sharing as much information as we can. Thank you.
Wonderful. Tango, I guess you want to answer as many questions as possible. So I'm going to ask all our participants to throw some questions at Tango in the participant chat. That's the mechanism we're going to use to engage with you. So do throw some questions at Tango. Harpia's got 8 years worth of experience in financial services. You know, many people like to keep it simple. but Harpier wants to engage his mind, particularly in complex portfolios. So you will see later on as he continues speaking through this presentation, just how well-versed Harpier is concerning financial planning, particularly business assurance. Harpier, you're one of the business assurance stars at PPS. Welcome. Thank you for being here. Thank you for joining us and sharing your knowledge with us.
Thanks so much, Keenan. It's a privilege to be, and thanks for everyone for joining us, and thanks for my co-host Tango as well. Looking forward to an exciting session today, and I want to further encourage you to make use of the chat functionality throughout the session today. The more questions we've got from your side, the more comments we've got from your side, the better the discussion at the end of the day, the more we can color in the picture that we're drawing today. So please, I want to encourage you to make use of that, as well as afterwards with the email address that Keenan shared with you guys. We'll share it later throughout the slide deck as well. Make use of it if you've got any further questions or if you want any other assistance, whether it is with business assurance or with any other type of financial planning that you might have a need for.
Absolutely. And that's the thing about the conversation, you know, Tango. Maybe we'll speak about something related to business, business assurance, but an idea might spark in our participants' mind about their personal finances. And they're welcome to reach out to you at any point in time with those ideas that spark. Guys, enough from me. You've got your poll going there. I see Craig Nelson is entering the room. And on that note, I'm going to hand over to Tango and to Harpier. I'm going to be kind of popping into the conversation here and there. If I see a question, I'm not interjecting. I just also want to be a part of the action with you too. Okay. Beautiful. Tango, over to you. Please tell us, how do we insure ourselves against the loss of the #1 player on our?
So to begin that journey, you will have noticed we held the webinar, the first webinar, a few weeks ago. And on this journey that you're seeing in front of you, it starts from the bottom left and moving up throughout towards the top right. And in that session, we covered the protection against the third-party creditors. And also in there, we covered about how do you ensure your business will be able to repay your loan. In today's session, we'll be focusing in and honing in on how do you prepare for the day you might lose your MVP, your most valuable player, and how do you secure your business future on your way to financial freedom. Okay, so what are some of the more important questions that one should be asking themselves? One, will the business have sufficient funds to pay all creditors upon a trigger event? Can the business afford to repay the loan I gave it on my death? What will happen if one of my star employees who has a unique skill set and contacts dies tomorrow? If my partner becomes disabled or dies, will I have the necessary cash available to buy his business interests? And will there be sufficient funds left for my family to meet their income needs? More questions maybe along the lines of, what will happen if one of my star employees dies, has a unique skill set and contacts, and that isn't necessarily a shareholder or partner, but just an identified employee within your business? Okay. And if my partner dies, will there be enough to buy his interest? And will there be sufficient funds left for my family to meet their income needs? So moving on to that now, we're going to set the scene and talk about how we keep the ball rolling and insuring against the loss of your #1 player. To illustrate this, we're going to begin by just setting the scene and telling the story. In this scenario, we have Claire, Sydney, and Tabiso. Now they met as students and at O-Week, and some of them were in res and did blommetjies and learned how to soki and langarm, and others just went for their parties before classes began, but they formed a very tight bond and indeed went on to even stay in digs and a commune together. Now you'll see from the three there, they decided to start a business. And Claire, having done BCom Business Management, looks after the operations, with Tabiso, who was more numbers inclined, went on to become a chartered accountant. And then we have Sydney, who did his BCom Marketing, and he is the sales and marketing guy. Now, upon starting this business, Sydney is the one who was able to bring the business. He formed all the client relationships and also looks after the entire client base. It's at some point that the three of them asked one another, what would happen if they had to lose Sydney? If they had to lose Claire, if they had to lose Tabiso? And it became as clear as day to them that if they had to lose Sydney, their business would be impacted in a big, big way. So it may seem quite simple when you look at it and from just what happens, business just carries on, but it isn't that simple at all. HP, how do you see it? What risks are Claire and Tabiso exposed to? How can they safeguard themselves and their business against any unforeseen circumstances that arise as a result of the death or disability of Sydney?
Yeah, thanks, Tango. You can see on just by those pictures that Sydney was definitely the bigger party animal of the three, the social one between the three, and therefore he's the one that's got all the relationships with key players, whether it is suppliers, whether it is clients, or any other individual that's important for the profits of the company. And should Sydney not be there, there are quite a few risks that they are now exposed to. First of all, the business will lose a very valuable skill and expertise, and it can be very difficult to replace such a person because as time progresses throughout this company, relationships were built. This expertise has been honed and it's been sharpened even more. So it's not that easy to just employ another person that's got a specialist marketing degree, for example, whatever, and they can just hit the ground running. A lot of times when it's intricate business relationships, it's very difficult to replace that specific person because the level of skill is not necessarily only linked to the academic side of things, but also the experience that was gained throughout the employment. And the thing is that can take quite a long time to replace such a person, to replace that relationship that this key individual had with key players within the company structure. And I see on the slide, it would say you can potentially suffer a loss of operating income, but I can almost guarantee you, if you lose one of your key players that had a strategic relationship in place, or he was one of the key reasons why the company has the profits, earns the profits that they do, I can guarantee you there would be a loss in operating income, even if it's just in the interim, but there will definitely be a knock on the income statement, if you could call it that. And then lastly, the sustainability and the profitability of the company would be significantly impacted. Not only the income, as I've just mentioned, but also because of key relations with whether it is with suppliers, that can also cause a bit of a concern when we get to the sustainability of the company. So a lot of times people would say, yes, I have a key person in my company, or I might even be one myself, but it's very difficult to put a number on that, to value, put a specific valuation on an individual's value towards the company. And therefore, it's important to get a specialist to sit with you to make sure that the value that you put onto this person is actually an accurate representation of what this person brings towards the game. And this key person is somebody that's essential in the running of the business and who plays this integral part in the success and the profitability of the business. And that can be either relationships that he's got, it can be knowledge or skills or expertise or experience. So it can be a various types of things, and a combination of things that he actually brings towards the table. And the specialist can sit with you and to determine this value, as I've just mentioned. And three ways that we actually determine this is, first of all, a multiple of annual salary. So we usually use his annual income and we times it by a factor of between 1 and 7. And that 1 to 7 factor would be a discussion with the shareholders or the directors involved to determine how important is this specific key person to the company. If he is like the be-all and end-all of the company, the factor would be close to 7. If he is just a person that's got a specific relationship or he's got a specific expertise that can easily be replaced, then we would look to a factor closer to 1, for example. Then second of all, loss in profit. So if this person is very important, he's got the relationship with important clients, important suppliers, etc. It can take quite a long time to replace this person. And in that period of time, profits might take a knock. So here we will have a discussion of how long does management actually expect this loss of profits would continue. How long would it take to actually recover? So things to consider there is things like his specific contribution towards the profits of the company, as well as the time that it would take to replace that relationship or that skill, so that profits can return to a normal level, if I can call it that. Then lastly, replacement costs. So this is the part where we look at recruitment, look at training, upskilling of a person, for that person to start gaining the experience that's needed to replace this specific key player within the company. And then a thing to consider as well is a temp replacement, especially when you look in the medical field. You get a lot of locums working within companies to replace key individuals. But the thing is, a locum usually the price tag on a locum is a bit more expensive than a permanent employee replacement. And a temp replacement can often have a significant price tag attached to it. So that's why that discussion is very important, to make sure that the correct value is placed on this key person's skills, expertise, as well as relations that he's got within the company. So let's look a bit further on how would we structure, after we've determined the value of this key individual, how would we structure a solution to make sure, so should something happen to Sydney, what would Thabiso and Claire do to make sure that that void has been filled? So first of all, we would take out a policy on Sydney's life, according to the value that we've just determined. And the policyholder would be the company, as well as the premium payer, as well as the beneficiary, because this risk policy would be taken out on the life of Sydney in this instance, to protect the business against the possible losses and to assist them in upskilling a new person, recruiting a new person, etc. So this is the typical structure that we would use to actually assist the company to fill that gap. So let's look a bit at the tax consequences when we're talking about this policy structure. So first of all, income tax. So the employer has an option here whether the premium should be deductible or non-deductible. In order for the premiums to be deductible, there are certain requirements that actually needs to be met. So let's have a discussion regarding the deductions first of all. If you decide to deduct the premiums against income tax, the proceeds from that life policy would then actually be taxed at 28%. If you decide not to deduct the proceeds of the premiums from income tax, then the proceeds would be exempt from income tax. And that's an important consideration to make. So should you decide to actually deduct the premiums, you must remember to adjust your cover amount to make sure that you've provided sufficiently so that you've got the cover amount including income tax. So that's another calculation that a specialist can assist you with to make sure that we've got the valuation correct and we have the correct instructions going to the accountant or auditor to make sure that if he deducted that everything is done correctly. And then second of all, to provide for income tax should the proceeds be income taxable. So a further tax consequence, we will look at estate duty. So first of all, the purpose of this policy was not affected by or at the instance of the deceased. So it's important to note these type of things to make sure that the policy would be exempt from estate duty if these requirements are met. Further, if you look at the premium, if the premiums should not be paid by the deceased, as I've mentioned earlier with the structure, the premium should be paid by the company themselves. And then lastly, the policy proceeds. This should not be paid into the estate of the deceased. That the proceeds should be paid directly to the company. And the proceeds should not be utilized for the benefit of any of the relatives or the dependent of the deceased. And an important thing to note here as well is if this specific individual should not be regarded as being in a family company. Now, what that means is that the shareholding within this company, not more than 49%, so 50% or more, if 50% or more of the shareholding within the company is between relatives, and one of these relatives, as mentioned, is this key person, it would be regarded as a family company, and then it won't be exempt from estate duty. And it's important to note, and a lot of people would ask me, but how would I know if a relative would be deemed as a relative close enough for it to be a family company? And usually that is within a 3 degrees. So that would be your in-laws, it would be your parents, your grandparents, going down towards your grandchildren as well. So as a general rule of thumb, you would say any person that you would marry and the eyebrows would be raised, that relative is close enough to be in a degree that would be regarded as being in a family company. So that's just a safe rule of thumb to make sure that to stay clear of the estate duty consequences. So if these are not met, then this would be a deemed asset within the deceased estate. And that value then needs to be included in the life cover amount that we would take out on this key individual's life. It would be the policy proceeds, although you can deduct all the premiums that was paid by the employer and a compound interest of about 6%. So it's important that you get the correct valuation. So if it's, for example, a family company, make sure that you provide for estate duty. This can be recouped from the employer, and it's crucial to provide enough. So a lot of times people would say, my estate duty, my estate's lower than 30 million, so I need to provide 20% estate duty. So what I'll do is I've got R1 million worth of life cover, for example. I'll just add 20% on top of that. So I need 1.2 million. But that's actually not the case. So if we do a simple math calculation, if you take 20% off from 1.2 million, you'll actually end up with less than 1 million rand. So it's important to make the correct calculation so the net amount is the actual value that we need to replace this key individual. Further to this, executor fees, due to the fact that the policy has a nominated beneficiary, the executor would not handle any proceeds, and therefore there would be no executor fees involved within this structure. So
I love what you're saying here. You know, many instances, the professionals that we serve are concerned with, running a business. And these are some of the other things that they might not have thought about or might not be looking at from time to time. And I guess that's exactly where we come in. I'm just picturing a professional listening, to what percentages you're throwing out, maybe possibly hearing them for the first time. If that is you, if you're listening to Hapia and you thought, oh my goodness, I never thought about that, I could be at risk here, I'd love for you to go either to the chat window or to email, and please get in touch with somebody from Hapia's team, and you can follow the email address lifeplan@pps.co.za. If you've got any other questions relating to tax implications or any other implications that you foresee, please pop it in the chat window. We'd love to table your question here. We welcome it. In fact, Hapia said it early on, to make it a rich discussion, we need those questions to come through so we can tailor it.
Yes.
Hapia, when maybe there's a question that you can tackle. In your experience, Hapia.
Yes.
Where do companies and particularly sole proprietors, where are they most at risk?
I think
when looking at
the
this,
biggest thing is with a lot of, especially the smaller companies, the smaller enterprises, a lot of them, they're not really aware of the risks that they are because being a company owner. A lot of people would say, well, this is a small company. If something happens to me, just close the doors. You'll get that a lot with this practices as well as, well, if I'm not practicing anymore, the business will just stop. But the thing is, you should remember that you have people that is in your employ. So you've got the receptionist, you've got other people working within this company, and should you not be anymore, those people have a massive problem. So a lot of times, especially the sole owners or smaller enterprises, they do not consider the risks. And it's important to just have the discussion. And I can guarantee you that this would be an obligation-free conversation that you can have with one of the specialists within PPS's Specialist Support Services Division. We can actually sit with you and look at your specific scenario, look at your financials, have a discussion with you to point out all the various areas that needs your attention and the way that we can actually solution. So it's important to just have the discussion to make sure it's not necessarily that you'll have to fork out a lot of money to have this analysis done. As a PPS member, you can actually obtain this type of valuable information free of charge, a full analysis company to see if everything is the way it should be actually, and if there are any tweaks or adjustments that needs to be done.
Awesome, Apia. Thanks for that. I see Mama Pudi has asked a question here, and maybe this one is for Tango. What makes PPS's offering different from Discovery for someone that already has cover? So
that's
give us some more context, but thank you.
We will be sharing that information later on in the presentation. What I am very excited about, though, and it evokes something in me, is the conversation around people with a private practice or sole proprietors. I was raised by a sole proprietor. He has, a legal beagle, a lawyer by profession, who went into business. And I think if I was this age at that particular point in time, I probably would have definitely told my father to be able to get such structures in place in order to safeguard the business and the family against any eventual incident, trigger event happening to them.
Yes, because I imagine that business owners just looking at growing the company. I mean, all your attention, all your efforts are going into just growth. But there's more to it than that, Tango.
He carries the entire business on his shoulders. If he doesn't work, then the whole business stops. And so you can imagine what that is like. You can also imagine if it is being wound up in the estate and it is sold at a value that is way below what is actually worth. Exactly. So it would be important to ensure that it actually gets the amount and the value of the business as it is worth at that particular point in time when that event takes place.
That's it. Tango, another thing also is usually whether it is one of the business owners or a key person within the company, you've put all your blood, sweat, and tears into this company. You've worked to build that legacy. You've worked hard to get the company up to a certain spot and to a certain profitability. It would be a terrible thing if all that legacy is lost because the structure was not in place. It would be sad to see a massive legacy gone by just because structure was not in place. And that's an important thing to note is you've worked hard to get to where you are today. Safeguard that legacy, safeguard that empire, if I can call it, that you've built throughout the years.
100%, Apia. And talking about structure, I'm sure you can see everybody the slide that's currently in front of you at the moment that talks about the benefits of a properly structured solution, which include the employer has a peace of mind that funds are available to absorb the loss of the person. It covers an operational loss during readjustment. It pays expenses of finding, employing, and training new employees, and it ensures continuity of credit and effectiveness of the business and its activities. So all of this is underpinned by the key person insurance, which compensates the business in the event of the death and or disability and or critical illness of an important person. And to sum up this scenario that we've actually been talking about, Apia, I mean, we've considered Income Tax Act considerations in particular, and we also considered the estate duty. And under those estate duty, I'm a person who always likes to think and learn in acronyms. And I couldn't help but come up with one as we're taking us through some of the requirements that must be met in order for estate duty to apply or not apply. And those, for me, I came up with a FRIPE. So it's FRIPE and fruity. So the FRIPE, the F for family company, R for relative, I is in the instance of the deceased, P is for premium, and E is the estate estate of the deceased, of the natural person. Okay. Great stuff. So let's move on to the next one, guys. Let's talk about
Tango. I will never look at the requirements for those exemptions to be at play with the same set of eyes that I used to. I'll definitely remember this acronym from now onwards. As soon as I'll have the discussion regarding taxes with for key individuals, I'll have a fright discussion with my client.
So if you talk about your partner in crime, everybody, I mean, you know, it's your Batman and Robin, Bonnie and Clyde, Ebony and Ivory. So to expand on the previous scenario, where we still have Claire, Cindy, and Tabiso, and they've built this company, but their lives have also progressed. And they've met certain individuals in their lives with whom they decided to live and get married together. So Claire is married to Johan, who's a farmer, and Tabiso is married to Veronica, who's a stay-at-home mom with 2 kids. So upon conversation, again, it sparks the conversation of what should happen in the event should Claire pass away, or Tabiso, or Sydney. Now there's the realization that, okay, perhaps when they're all having a staff end of year get together, that Johan and Veronica don't particularly see eye to eye, nor do they have the skills and expertise and experience to be able to step into the shoes and fill the shoes of their significant others and be able to continue moving the business forward. So it gets a bit murky here yet again. And I'm going to look to you, Hopia, to please take us through what you think would be the things to be considered and the way to go about getting this right.
That's a thing, Tango, is now you've grown this empire quite a lot, and you've got intricate relationship within shareholders. Each shareholder has its specific role within the company. As you've seen earlier when we discussed Tabiso being the CA, for example, Sydney in marketing, etc. And now, should something happen to Tabiso and the structure is not in play, his shares can actually go down to, for example, Veronica if she inherits his estate. Now, Veronica is actually a shareholder within ABC Pty Limited. She does not necessarily have the skill set that Tabiso used to have, being a CA, etc. And now you in partnership with a person that does not bring to the table what Tabiso used to bring. As an example. So it's very important to make sure that the structure is in place, and the failure to have a proper succession plan in place is that now there's a lot of uncertainty to things like who would replace this deceased partner or shareholder in the business. The danger exists that the business may have to be liquidated because now these shares need to be bought out should we want to make sure that the share stays within the company, and we do not have provision for this. So now there's a lot of money that needs to be forked out here. Another thing is if there would be this sufficient finances to purchase this interest from the estate, as well as now Tabiso, for example, passes away, what would be the purchase price involved here now? Now, as an executor, I'm sitting, how can I wind up this estate now? There's not a specific value. There's no specific arrangement as to what happens with the shares. So the estate takes forever to wind up. A few other consequences to consider. There's quite a few on screen at the moment. Definitely the business will be interrupted. Should one of the shareholders pass away or become disabled, for example, there would be a massive interruption within the business. What would be the immediate plan of action? How would we go further? Another thing, as I've mentioned earlier, is the possibility of an unskilled person now entering the business due to the inheritance. That could even be the executor of this deceased estate. He would now take the place of the deceased partner. So now the executor, for example, of Tabiso's estate would now sit and have a say within the company as long as this estate needs to be wound up. So that it can be quite problematic if everything is not looked after and if the structures and the agreements aren't in place. Should an option actually exist to buy these shares, as a further example, the surviving partners, if they do not have provision in place, now they have to either fork up some of their own finances or they have to dig into the funds within the company, and that can create a massive cash flow issue within the company as well. And then there are quite a few other things as well to consider. If you can look on the screen to just name a few, and actually there are a lot more consequences not mentioned here that could also be at play. And that's why it's important to make sure that you've got the correct structure in place, that make sure that you've got provision for all of these type of things. So what can you do? What can you as a business owner do in a scenario like this? And I think it's an appropriate time to perhaps go to the chat functionality again. And Keenan, if you can assist with any questions perhaps or any comments, maybe
Yes.
if you guys can comment to say there, who of you are business owners and you are concerned? Maybe if you can comment with, I have an agreement or I do not have an agreement in place. I have a policy in place or I do not have a policy in place, because it's important to not only have the policy in place, but also the agreement, because everything needs to work in harmony. And that's one thing where a lot of times the ball gets dropped on the floor.
Hoppy, I'm just looking at our polling results as well. 60% of the people who answered the poll said that they do not have a buy and sell plan in place. So that's, if that's any reflection to go by, 60% of the people who answered that.
I'm actually, Keenan, I'm actually not surprised of that figure, because you get that a lot when you have this discussion with clients. Then they'll say, yes, back in the day, we did take out policies on each of the shareholders. But first of all, the value of the company has increased significantly since then. Second of all, usually they're not aware of any contract or any buy and sell agreement as such that's in place. And that creates quite a lot of issues. First of all, the solution is, as I mentioned here, is the business owners needs to enter into a contract that determines the purchase price of their partner's interest, as well as the buying and the selling of this interest. So first of all, for example, let's like Claire this down. Claire, something happens to Claire, her shares now, it would force her to sell her shares back into the company. So Sydney and Tabiso would buy those shares. So first of all, it forces the deceased party to sell these shares, and it forces the surviving parties to buy those shares. So first of all, that ensures that the shares stays within the company, within the expertise within the company. That also ensures that the estate can be wound up properly, because now there's not a share within the estate, but only a cash value that gets paid out by the life policy. And that's where step 2 comes in, is each owner would effect a life policy on the lives of all the other co-owners. So Tabiso would have life cover, Sydney would have life cover, as well as Claire. And the important thing is that the life policy, as well as the agreement, needs to be in sync with one another. So first of all, the agreement needs to speak to the memo of incorporation as well as the shareholders agreement to make sure that all the various aspects within this company structure is looked after properly. And then the life policy needs to be in play here to make sure that there's sufficient provision to buy these shares, to make sure that everything is done effectively and efficiently. Another note here is the buy and sell agreement also plays almost like the same role that you would have your last will and testament in your personal capacity. This would be at play within the company. So you can almost look at it as a will and testament of the shareholders within the company. And it's important, that's the type of importance that you need to look after this agreement, and how important it is to actually have it in place. To structure this, we'll look at, for example, in Sydney's case. So on Sydney's life, we'll have Sydney as the life insured. We'll get the appropriate valuation according to the valuation methods that we would use. We'll look at the financials of the company to make sure that the company's value is X amount. So for example, Sydney owns 1/3 of the shares in the company, then 1/3 of the company's value would be the life policy, or the value that Sydney would be insured for, and then also taking into consideration any taxes that might be applicable. Policy holding would be the other 2 shareholders, so it would be Tabiso and Claire, and it would be also in proportion to the shareholding that they've got within the company. This is usually, as a rule of thumb, how it works. Sometimes they'll have a discussion and say, well, Thabiso would buy out all Sydney shares. Claire's shareholding would remain the same. So then Thabiso would be the only policy holder, premium payer, and beneficiary of Sydney's policy. But that's the type of discussion that you'll have with the shareholders when you're doing a meeting and doing an analysis for them. As a rule of thumb, usually it gets split up proportionally. The premium payment would also be split up the same way, as well as the beneficiary payments, because each individual shareholder needs to purchase the shares from, for example, in this example, Sydney. So Thabiso needs to purchase the shareholding in proportion and not the company themselves. So the shareholding and the policy needs to be within the shareholders in the company. So let's look at tax consequences. So first of all, income tax. Premiums are not tax deductible. With the Keyman solution that we've discussed earlier, you have the option to either deduct the premiums or not. With a buy and sell agreement, Income Tax Act does not allow deductions of premiums paid on these policies. So the premiums are not deductible. But because of that, the proceeds are therefore exempt in terms of Section 10 of the Income Tax Act. So therefore, you do not have to make provision for income tax with these policies because the proceeds would be income tax free. The sale of this interest in the business is a capital transaction, and that's the reason why there are no income tax implications. Further to that, capital gains tax. The proceeds of this risk policy is used to fund the buying and selling of shares or interest in the company and are exempt from CGT. So that's another thing to also take note of. Then further to this, estate duty. So this is also a very important thing to consider, as the policy might be exempt from estate duty, but it might not be. And it's important to make sure that you look for these specific requirements to make sure that if you are not providing for estate duty, that all of these requirements are met. So first of all, the partnership or the shareholding must be in existence at the time of death. So I think that's an obvious requirement. Then secondly, the deceased cannot have paid any of his own premiums on these policies. So a lot of times you get people that pay their own, shareholders that pay their own premiums. And once you've paid a premium on your own life within one of these structures, you'll actually open yourself up for a estate duty payment. So it's important, if you have made payments on your own premiums, that you actually cancel that policy and start a new policy afresh and not pay your own premiums, because that can actually have a massive effect at the end of the day, because that estate duty implication is a massive value. If you look at a 20% value as a rule of thumb, you can have a massive shortfall if you didn't provide for estate duty, and at the end of the day, SARS comes and tells you that your policy is actually not exempt from estate duty. Further to this, the purpose of the policy must be to purchase the deceased interest in the business and or his loan account. If you've remembered from our previous session where we've spoken about credit loan accounts, if the loan account's included in the buy and sell, that's also be included in the estate duty exemption if all these requirements are met. And lastly, the deceased must have held his shares in the company as a natural person. So your ID number should be the one linked to the shareholding, not, for example, a different company or a trust or whatever the case might be. And that's the important thing to note, is it must be a natural person.
Yeah. If I can just come in there. I mean, for me, talking about the buy and sell agreement that you have just taken us through, three things that stuck out for me. So the first one was more of a consideration around, what if the business is in its infancy stages? It has not reached its full potential. And I think the answer there for me, I managed to answer myself, was to say, it's more like us in our individual capacity with our life stages. So you may take out life cover at a particular point in time, and that changes once you add a property and an asset. It changes once again, maybe you adopt or you have children and you have dependents, and then it changes again, later on. So with the business as well, I think, whether it's if you have the structure in place, you can then edit and change the value that you'd like to make cover for as the things change, as your business grows and matures. That's the number one. Then the second one, again, on the slide that you have up here, you talking us through these estate duty requirements that must be met. You know, to me, I just saw P's. You mentioned P's all the time. And I just kind of randomly came up with the 4 P's. You know, P number 1 being for partnership, must be in existence, or shareholding, must be the premium. Must that means purpose and person, natural person. So that kind of helps me. I think that will help me to stick and to know what needs to be considered for estate duty purposes of a buy and sell agreement.
Oh, that's
And
the
then you
thing.
can tell that you work for PPS. You're really prime there for all those P's.
Yeah.
Maybe I can speak to all the participants on the call right now. Here's my question, and go to the chat window and I want you to type a year, right? So the question is, when last did you speak to your financial advisor or financial planner or financial expert about your buy and sell agreement, to those that have one in place? And when last have you spoken to your partners about that scenario that may play itself out? Just go to the chat window. For those of you that are business owners, I think 67% of you said you are. So go to the window and tell us, when was the last time you had this conversation, either with a financial planner or with any of your shareholders? And then on the back of that question, Harpia, maybe I'll go to you and say, what's the recommended frequency of this conversation? Tango's guiding us to say at every point, at every stage where there's a significant change in your business, have the discussion. But is there a planned, structured approach that we can take as well?
Yes, Keenan, I'm so thankful that Tango, the master of acronyms, is with us to simplify all these technical things for our members out there, to give them simple acronyms to make this a bit more digestible.
Yes.
To get back to that is, as Tango mentioned, is even if the company is in the infancy stage, I would also compare this to your normal life stage. Is now you started working, you started earning an income, etc. So now you get a basic will and testament in play. It's not much, it's just a standard will and testament in play. And then from there on, as you progress through life, if you get children, then you might change your will and testament a bit to provide for children, maybe get a testament to trust or whatever included in the will, for example. And as you progress through life, you make the amendments. The same with a buy and sell agreement is, once you start a company, it's very important to get that structure in play from the beginning, because then it's much easier to continue throughout the life stages of the company. So then on an annual basis, you can sit with the specialist or with your financial advisor and just update the values, because if there hasn't been any changes within the shareholding of the company or with anything regards to the memo of incorporation or the shareholding within the company, then the only thing that we need to adjust is the valuation of the company. As the company grows, we would increase the value and therefore make sure that the policies are also in line with the new valuation. So I would say on an annual basis, at least look at the valuation of the shareholding within the company to make sure that, first of all, you get the correct amount for the shares that you hold within the company. But second of all, as well, on a personal side, when you do your estate planning, now you can actually have a specific value within your estate plan to say, my shareholding is worth X amount as of this year, 2020. So that makes that a calculation a lot more accurate, and you can make your personal as well as business provisions accurately to make sure that you're, first of all, not over or underinsured, but also to make sure that everything is in line, to make sure that all the bases are covered. So valuation definitely at, once a year. And then if there is any changes in structure, we'll look again at the buy and sell agreement to make sure that it's provided for accurately and correctly.
Awesome. Thanks for that, Harpia. I don't see anyone speaking to us about when last they spoke to the financial planners or their shareholders, and maybe just an indication that the conversation needs to happen. So you guys are welcome to continue, with the next scenario.
Yeah, I think where we left off last is when we discussed the 4 Ps, as the master of acronyms just called it. And the last one is regarding a natural person. And what happens should this shareholding not be in a natural capacity. So for example, Tabiso, he has got his own trust, his own discretionary trust, and he actually has the shareholding of ABC Pty Limited in his trust and not in his personal capacity. Although Tabiso is the main trustee of the trust or whatever the case might be, still the shareholding would be linked to the ID number of the trust and not Tabiso's ID number. And therefore, the shareholding would be not a natural person. And therefore, there would be some consequences regarding estate duty. So first of all, it would be included in the deceased estate as a deemed property. And it would be estate dutiable. So it's then once again crucial to adjust the cover amount to provide for this estate duty. So for example, Tabiso in this case that's got his shareholding within the through the trust, you must provide to do that calculation, as I've mentioned earlier, at the key person the same year. You must provide for estate duty to make sure that you actually have sufficient proceeds to actually for the surviving partners to buy your shareholding. So this would be, estate duty will be payable by the surviving partner. So it's crucial to make sure that they don't have a shortfall. If you did not provide for estate duty, there would be a shortfall, and then once again, that shortfall needs to be provided for by the surviving shareholders or from your specific estate as well. So it's important to make sure that that is correctly in place. So executor fees, once again, due to the policy having a nominated beneficiary, the executor will not handle the proceeds, and therefore it would be executor duty free, if I can call it that. So the benefits, if we look at this solution, is, as I've mentioned, it's not only a policy that's in play, but also an agreement. So there are benefits for everyone involved. So first of all, let's look at the business. This guarantees the stability and the continuity of the business. So if I've got the agreement in place, I know exactly what happens. Should somebody pass away, what happens to his shareholding? Who's going to buy what and for what value? Secondly, it also ensures the goodwill of the employees and creditors within the company. So now as an employee, I work for a company, but I know that should something happen to any of the shareholders, everything is looked after. And not only that, creditors as well, is they can see that the business can actually continue as usual. So we're not concerned that you're owing us money and now the structure is falling to the ground. And then also it prevents the business from being drained of capital resources. Now, if you do not have the policy in place, you now have to fork up either additional capital contribution from your personal funds into the company, or you use the capital resources already in the company, and that can cause a significant effect in the normal running of the business. Then the surviving partners, it creates the necessary liquidity, so that should something happen to one of the shareholders, whether he becomes disabled or passes away, that you can purchase his interest without having a knock on your own finances or the company's finances. And it also ensures you that the shareholding stays within the company. Like, for example, that we had earlier, Tabiso is married to Veronica, and she does not necessarily have the skill set that they need within the company. So that ensures the surviving partners that we do not have an external shareholder in the company that does not necessarily have the skill set needed for this type of job. So the full ownership is guaranteed also at a specific value. So then you can make sure that I know what the value is that I'm purchasing the shares for, as well as the deceased side of things. I know what the value is that to include in my own estate planning, and I know what the value would be should I pass away, what capital or what cash value would be paid out to my estate at the end of the day. And then on the family side, it eliminates the uncertainty for the heirs as the buying and the selling of the shares. They don't have to handle anything of that. It's not a problem for the executor. Everything is sorted within the buy and sell agreement. It's almost like a will and testament. There's clear instructions what's happening now, and the estate can be wound up timelessly. It's not a long-winded process because things aren't in place. And that's an important thing to know as well. And it also limits the dispute among the heirs. So if you do not have everything in place and the shareholding goes to the estate, now there are quite a lot of heirs and they don't know what to do with the shareholding. They don't know who needs to continue with the responsibilities. They don't know who at the end of the day has to do what in order to finalize things. And it also guarantees a reasonable price in cash for the heirs. So it's a lot simpler, it's a lot easier. And I usually use the KISS principle, keep it straight and simple. And I think Tango would appreciate my own acronym. And this, when you have a properly structured solution, it complies with the KISS principle of keeping things straightforward and simple. The executor knows exactly what he needs to do. The estate planning side, on your personal side, you know exactly the value to put into your estate. So everything is in harmony. And that's the most important thing with a properly structured solution, is so that everything is in sync with one another. The memo of incorporation speaks to the agreement speaks to the policy, and vice versa. Everything is in harmony. And that's where the business provider policy links up everything, and to make sure that all the various needs are looked after properly, not only with an agreement, but also with the correct policy in place, with the sufficient provision for all the various taxes involved within this place. And then after that, I would like to thank you for today's session. If you've got any further questions, please make use of the chat functionality, as well as the email displayed on the screen currently. From my side, that is it. If you've got any further questions, I think we will I will head over back to you, Keenan and Tango, for some comments afterwards. But that's from my side, my story.
Yeah, so I mean, from my side, I think you touched on a few things in the closing, and the three things that come out for me, that jump out at me, is to ensure that your capital needs are catered for, the income needs are catered for those that are left behind, as well as the legacy. So having been part of this business, you would have built it, for a legacy purpose. And unfortunately, if you're not there to see it to that stage, and those that are left behind may or may not be interested in getting into that business, but at least the value that it is worth will be paid out to those that are left behind. Then, of course, there's the tax considerations, which can be quite complicated, and the job of the specialist and financial advisors is to uncomplicate it and use layman's terms to make it understandable to, you and I, people that don't work, or people that don't work with this information often, which is Income Tax Act, there's estate duty, and capital gains tax considerations. So that's all from my side. Thank you, everybody. Thank you, Hopia. Thank you for all that information. Keenan?
Awesome. Thank you so much, Tango and Hopia. I just want us to remember Mama Pudi's question, and Boitomelo's also reminding me here. The question was, what makes PPS's offering different from a company like Discovery for someone that already has cover in place? Maybe I'm going to
jump in there, Keenan. First of all, we've got a saying in PPS where we say professionals for professionals. So first of all, we understand your type of business. We understand the way a professional would run a business. We understand the type of businesses that professionals are involved with. So the type of service you'll get from our side would also be of that type of nature, the type of discussions we will have with you, whether it is regarding the structure of the agreements, whether it is regarding the valuation of the company, etc. We understand the various elements at play when it comes to professional practices. So first of all, that added value, and as a member of PPS, you get this service free of charge. So you can email LifePlan at PPS or contact your financial advisor and ask to get a specialist to look at your business needs, to look at the agreement that you currently have in place, as well as the policies, to see if everything is in sync, to see if the values are correct, to make sure that everything is looked after properly. So that's also an added benefit, that all of this comes free of charge to you, our valued PPS member. And then on the buy and sell side, if you're a PPS member in your personal capacity, you can even earn an indirect profit share from your buy and sell cover on the policy amounts that you pay premiums for. So there are quite a few benefits at play, and that's just a few, just to mention. And if you're not part of the PPS family, it's a crucial part of the planning of a professional is the business planning side. And I would encourage you to join the family. It's awesome to be part of this mutual.
Awesome, awesome. Thank you so much. I love that you opened up your answer with an invitation to say, if you want to be served by a team of professionals, then PPS is definitely the company where you are supposed to be. I'm looking at the chat window. I see there's a nice conversation going on between, I think that is Victor and Boitumelo about the question. We're just going to keep the chat window open for one more, a couple more minutes. So throw some questions at Harpier and Tango. Things you guys did so beautifully here on this webinar today is, with expertise, Harpier and Tango, with your ability to put things into an easy, palatable formula like an acronym, you've helped demystify the complexity here. Our business owners on the call, don't feel like you are alone in this. You've got help and you've got support in the form of PPS advisors and specialists that can navigate that conversation and think through some of the risks that exist for you and for your business. So thank you for doing that so nicely, Harpier and Tango. I'm just looking at the chat window. Are there any other questions concerning your business's insurance? Do you have anything top of mind? I want to just remind you that the only silly question is the one that is never asked. So do be bold, be courageous, ask us a question there. Let me look at the participant window. We've got Tarina, we've got Rajesh, we've got Victor, we've got Valencia, we've got S. Naidu, we've got Lawrence Nell, Hanami, Frick, Craig, Boitumelo, Tsulu, Tango, you, Harpier here, Babal was here, Fadla's here. Awesome. We've got a few participants in this webinar with us right now. Don't be afraid to ask a question. Tango and Harpier are ready. Look at how they're sitting. They are engaged. They're waiting for questions. They're ready to answer. Yeah, and it's an interesting title we had of this webinar, protecting your company against the loss of an important player. That important player could be you on this webinar, and it could be other people outside of this webinar. So you've got to think wide. You've got to think wide. You've got to think wide. Awesome. I see Victor's asking a question here. Is there any documented information or proposal that one can send clients in order to consider buy and sell? Well, I've got an answer top of mind. I think, Harpier, maybe I see you giving me the non-verbal signals there that you kind of have an answer as well. Victor, something that you missed in the beginning of this webinar, as I said, this is really an opportunity to connect with our valued members, to connect with professionals in their own business. So one way was really to jump on this call. The second thing was, of course, to open the platform up with Harpier and Tango to get involved, to avail themselves, to speak to our members. But Harpier, you're gonna obviously answer Victor a little bit more directly than that, hey?
Yes, Victor, there are quite a few things that we can actually send your way as marketing material. There are quite a few brochures out there. And then also, if you have this need and we need to assist you with a virtual consultation during lockdown, the whole team of specialists at PPS are available for virtual consultations. So we can even come with you on one of these. And at later stage, when we return back to normal, we can even sit with you as well as the shareholders around a boardroom table and have a full discussion. So all of these things are available to any of our PPS members, as well as advisors and brokers out there. Make use of us. That's our service to you. We would love to meet you guys, and we'd love to sit and make sure that all your dreams are protected within your company structures as well.
Beautiful, beautiful. I don't see any other questions coming up, gentlemen. If I do see something, I'm going to definitely pay some attention to it. But in the closing moments of this webinar, I just want to first extend gratitude to all the participants who voted with their fingers by clicking on the link and actually coming through to attend this webinar. Thank you. Thank you for attending the webinar. Thank you for being here and for engaging with our poll, for engaging our panelists with the questions. Craig Nelson is asking for the presentation. Sees lots of value in that presentation. So I'm sure Harpia will share that with you. Thank you to you and Tango, Harpia, for being a source of wisdom and a source of knowledge today. You've helped us navigate this conversation really well. So I must extend some gratitude to you. And then to everybody else who joined us on this call, thank you. We wish you every success in your business. We wish that your business grows from strength to strength, and that you continue to navigate these uncertain times, you know, with as much certainty as you can. And that's kind of what we are asking you here, is to say, let's get as much certainty as we can concerning your business insurance, your business assurance. Let's get that in place, and let's make sure that your dreams are protected, as Harpia says. So from the entire PPS team, both on the call and behind the scenes, we'd like to say thank you for being here. And maybe we can call it a day, guys. What do you say? Tango, Harpia, you guys.
Thank you very much to everybody, guys.
Yeah.
It was really good. Yeah, all the best. Thank you very much for coming out.
Beautiful. Beautiful. Thank you, everybody.
Yeah,
Have a
from my
wonderful
side
time.
also, thanks a lot. Also to my co-host. Sorry, I think the connection today. Yeah, just thanks from my side as well. And if you've got any further questions, please make use of LifePlan at PPS. If you think of a question afterwards, send us an email. We'll be in touch with you. You'll also get a follow-up email from our side to be in touch. I know there's a lot of people that might be interested in the presentation, in the recordings, etc. I know that we are recording the session, so if there's any need of like that, we will definitely be able to assist accordingly. So thanks once again from my side as well, and yeah, stay safe within these challenging times that we're currently facing.
Absolutely, absolutely. Thanks so much, Harpia. Thank you so much, Tango. Everybody, thank you for joining us. Have a safe week further. Have a productive week further until we meet each other in one of these virtual webinars again. We'll see each other soon. Goodbye, everybody.